there is a company in India that sits right at the intersection of two massive industries. One is financial technology, and the other is business software. But what makes this company interesting is that it is not simply another payment app, another software company, or another fintech trying to compete with banks. It is trying to become something much bigger. A platform that sits inside the financial and operational ecosystem of thousands of companies. And that company is Zaggle Prepaid Ocean Services. Now, the stock has recently come under serious pressure, and that is exactly why I think this company deserves a much closer look. Because when a stock falls sharply, the first question should not be, why is the stock falling? The better question is, has the business actually become weaker? Or has the market simply become less excited about its growth? So in this video, we are going to look at Zaggle from the ground up. What exactly does the company do? How does it make money? Why are companies using its platform? What makes its business difficult to replace? How strong are its financials? And most importantly, can Zaggle continue growing fast enough to justify its future potential? Let's start with the business itself. Think about a large company with thousands of employees. Every month, that company has to deal with travel expenses, employee reimbursements, corporate cards, rewards, vendor payments, invoices, employee benefits, and hundreds of other financial transactions. Normally, these activities can be spread across different systems. One system for employee expenses, another for corporate cards, another for rewards, another for vendor payments, and another for accounting. This creates a huge problem. The company has data everywhere, but very little control over the entire spending process. And this is where Zaggle comes in. Zaggle is essentially trying to bring all of these activities together on one technology-driven platform. This is what makes its business model particularly interesting. It combines financial technology with software as a service. In simple words, Zaggle is not just helping companies move money, it is also helping them manage how that money is spent. And that distinction is extremely important. Because once a company's employees, finance teams, and vendors become integrated into a platform, switching to another provider becomes much more difficult. And that brings us to one of Zaggle's biggest strengths, its ecosystem. Imagine you are a large company and you are already using Zaggle to manage employee expenses. Your employees are using corporate cards. Your finance department is using the software. Your reward programs are connected. Your vendor payments are being processed. Your internal systems are integrated with the platform. At that point, Zaggle is no longer just another service provider. It becomes part of the company's daily financial infrastructure, and that can create a very sticky relationship. According to the information we are looking at, Zaggle's customer churn has been around 1.54%. That is an important number, because it suggests that once businesses enter the ecosystem, they are not leaving easily. And this is one of the characteristics investors should look for in a technology business. Not just how many customers it can acquire, but how long those customers stay. Now, let's talk about how Zaggle actually makes money. The company has multiple revenue streams. One of them comes from program fees associated with its prepaid card and transaction ecosystem. Every time customers use the financial infrastructure, Zaggle can potentially earn fees from the activity. Then, there is the software side. Companies pay for technology that helps them manage expenses and financial workflows. And then you have platforms such as Propel and Zoya. These businesses expand Zaggle beyond simple card transactions and into areas such as rewards, invoice management, and vendor payments. And this is where the business model becomes particularly interesting, because instead of depending on one product, Zaggle is building multiple products around the same corporate customer. Think about it this way. Zaggle gets a company as a customer. That company may initially use one service, but once Zaggle is integrated into the organization, it has an opportunity to sell additional services: corporate cards, expense management, employee rewards, vendor payments, invoice clearing, and other financial workflows. So the same customer can potentially generate revenue across several products. This is much more powerful than constantly having to find completely new customers. And this leads to another important question. Why can't another company simply copy Zaggle? Well, the technology itself may not be impossible to replicate, but the ecosystem is much harder to replicate. According to the information provided, Zaggle has partnerships with more than 50 major banks. That gives the company access to a much broader financial network. And this is where its banking relationships become important. Zaggle doesn't necessarily need to become a bank itself. Instead, it can build technology and financial services on top of existing financial infrastructure. This allows it to operate at the intersection of banks, businesses, and employees. And that creates what we can call a distribution advantage. The more companies and financial institutions connected to the ecosystem, the more useful the platform can potentially become. Now, let's move to one of the most important parts of this analysis: the financial performance. Because a great story is not enough. A company can have an amazing product, a huge market opportunity, and thousands of customers. But if it cannot turn that growth into profits and cash flow, investors eventually start questioning the business. Zaggle has demonstrated strong revenue growth over recent fiscal years. The company has been scaling its transaction volumes and expanding its customer ecosystem. And that is exactly what we want to see from a company operating in a growing digital financial market. But there is an important warning here. Growth has not been perfectly smooth. Recent quarters have shown pressure on margins. The company has been spending money on technology, expansion, and acquisitions, and that can create a temporary mismatch. Revenue may continue growing, while profits don't grow at the same speed. And this is one of the biggest things investors need to watch, because there is a huge difference between good growth and profitable growth. If Zaggle spends money today to build an ecosystem that produces much higher revenue and profits tomorrow, the temporary margin pressure could eventually make sense. But if expenses continue rising without the expected improvement in revenue and profitability, then investors have a problem. And this is where the recent acquisition strategy becomes important. Zaggle has been expanding through acquisitions, including businesses such as Dice Enterprises. The logic behind acquisitions is straightforward. Instead of spending years building every product internally, Zaggle can acquire an existing business and integrate it into its ecosystem. If that integration works, Zaggle gets additional customers, technology, products, and revenue. But there is also a risk. Acquisitions can look attractive on paper and still fail to generate the expected returns. Employees have to be integrated. Technology systems have to be combined. Customers have to be retained. And management has to make sure that the acquired business actually improves the overall economics of the company. So when we look at Zaggle today, I would not simply look at revenue growth. I would watch what happens to margins after these investments and acquisitions. That will tell us whether the strategy is actually working. Now, let's talk about something that makes Zaggle particularly interesting. its potential transition from a high-growth company into a much more mature, cash-generating business. In the early stages of a technology company, the focus is usually on acquiring customers and expanding rapidly. Profitability may not be the immediate priority, but eventually, investors want to see something else. They want to see operating leverage. That means revenue continues growing, but expenses don't increase at the same rate. If Zaggle can reach that stage, the economics of the business could change significantly. Imagine the company continues adding customers, but the technology infrastructure is already built. The software is already developed. The financial relationships are already established. The distribution network is already functioning. Now, every additional customer can potentially add more revenue without requiring the same level of additional cost. That is where technology businesses can become extremely powerful. But again, this is a possibility, not a guarantee. And investors need to watch the numbers to see whether Zaggle actually achieves it. Now let's look at the bull case. Why could Zaggle become a much larger company over the next several years? First, corporate spending is becoming increasingly digital. Companies want better control over their expenses. They want real-time visibility. They want automation. They want employees to use digital payment systems. And they want finance teams to spend less time manually processing transactions. All of these trends potentially benefit a company like Zaggle. Second, the company operates in a very large corporate ecosystem. There are thousands of businesses in India that still have fragmented expense management and payment systems. If Zaggle can capture more of that market, the opportunity is significant. Third, there is the cross-selling opportunity. A company that starts with corporate cards can potentially move into expense management, then employee benefits, then rewards, then vendor payments, then other financial workflows. So the opportunity isn't simply to acquire more customers, it is to increase the amount of business generated from each customer. And fourth, Zaggle's banking partnerships give it an important advantage. Having relationships across the financial ecosystem can make it easier to distribute products and services at scale. But now, let's look at the other side. Because every investment story has a bear case. And Zaggle has several risks. The first is margin pressure. This is probably the biggest near-term issue. If revenue continues growing but profitability keeps getting squeezed, investors may become increasingly uncomfortable. The second risk is acquisition execution. Acquisitions can accelerate growth, but they can also create integration problems. If management pays too much for acquisitions or fails to generate the expected synergies, shareholder returns can suffer. The third risk is dependence on corporate spending. Remember, Zaggle's ecosystem is connected to businesses. If companies reduce spending during an economic slowdown, transaction volumes and demand for some services could also slow down. The fourth risk is regulation. Financial technology companies operate in a heavily regulated environment. Changes in rules governing prepaid instruments, corporate cards, payments, or financial services can affect how these businesses operate. And finally, there is competition. Zaggle may have a strong ecosystem today, but the corporate financial technology market is not going to remain empty. Banks, fintech companies, and software companies can all compete for the same customers. So Zaggle has to keep innovating. Now, after looking at all of this, let's come to the most important question. Is Zaggle fundamentally a strong company? I would say the answer is. The business has several very strong characteristics, but investors should not ignore the current financial pressure. The company has a differentiated business model. It combines software with financial infrastructure. It has multiple revenue streams. It has a large corporate customer base. It has strong banking relationships. And its platform can potentially become deeply embedded into the financial operations of its customers. Those are meaningful advantages. But at the same time, the recent margin pressure tells us that the company is going through an important phase. Management is spending money to build the next stage of growth. Now, the market needs proof that those investments will actually generate stronger profits. And that is what I would be watching very closely. Revenue growth, profit growth, margins, cash flow, customer retention, acquisition performance, and most importantly, whether the company can increase the amount of revenue it generates from its existing customers. Because if Zaggle can successfully combine all of these things, then the company could potentially evolve from being just another fintech stock into a major corporate financial technology platform. But if growth slows down while costs continue rising, the story could look very different. And that is why I don't think Zaggle is a simple buy because the stock has fallen story. A falling stock price does not automatically mean a stock has become cheap. And a growing company does not automatically mean it is a good investment. We have to look at the business, the financials, the valuation, and the risks together. For Zaggle, the long-term opportunity is clearly interesting. The company is operating in a market where businesses are moving toward digital expense management, automated payments, and integrated financial technology. And Zaggle is trying to capture that entire ecosystem instead of focusing on just one product. That could be its biggest strength. But now comes the part that will determine whether this becomes a great investment story or simply an interesting business story. Execution. Can Zaggle maintain strong revenue growth? Can it improve margins? Can it successfully integrate acquisitions? Can it retain its customers? And can it turn its growing ecosystem into consistently higher profits and cash generation? Those are the numbers I would watch over the next few quarters. So, what do you think about Zaggle? Do you think this is a temporary phase where the company is investing aggressively for future growth? Or do you think the margin pressure is a warning sign that investors should take seriously? Let me know your view in the comments. And if you enjoyed this fundamental analysis, make sure you like the video, subscribe to Retail GoPro, and turn on notifications. Because on this channel, we don't just look at stock prices. We try to understand the businesses behind those numbers. Thanks for watching, and I'll see you in the next video.